Welcome. This is Tax Pro Nation, the home of the independent tax professionals, where you can find a tax community, maximize your earnings, and live life on your own terms. I'm your host, Imelda Ledesma, COO of Pronto Tax School. In this episode, Andrea and Andy will break down how to report income for your fix and flip clients and the key difference between Schedule E and Schedule C reporting.
All right. Andy, you want to kick us off or you want me to start?
I think this is one of the topics that, like I said, I actually know the least amount about in real life. So I know we had provided a scenario. I feel like a lot of us learn best by looking at a scenario. So if you want to kind of dive into it, I can definitely pepper some questions as we go. And I'll also keep an eye on the chat for anybody that throws something in there.
So I'm going to do like I did last week, and I'm going to share my screen that has the scenario on it because it is kind of a lot of info. I feel like it'd be a little too much for me to just spout off at you. So first, I'm going to share this Word document. And this was the scenario that Andy came up with. A lot of this stuff is stuff that you may have seen from some of your clients, maybe not. He threw in a combination of a couple of different things and options. The main focus of today's conversation is going to be on house flipping, but we're going to touch a little bit on what happens if, let's say, they intended to flip the house, but they can't sell it, so they keep it as a rental. What happens then? So we're going to touch on that because that could definitely happen. So in this scenario, we're looking at a couple who are married. They're both doctors, so they have W-2 positions at a medical practice or whatever. They are starting to invest in real estate because they don't want to be doctors forever. They want to start living off some passive income. They attended one of those real estate seminars that if you work with real estate clients, you know all about, and the clients pay good money for them, and they take everything they learn there as gospel. So they attended some seminars. They started investing heavily in real estate. Their goal is to live off the passive income from their real estate within 10 years. So now they own 10 residential rental properties. So they've got 10, we'll just say long-term rentals. That net is bringing in around $50,000 a year, give or take. Last year, they both quit their jobs to go all in on real estate investing. So prior to the current tax year, they left their W-2 positions. Now they're both full-time in real estate. Based on, if you've attended any of my prior sessions where we talk about passive versus non-passive for rental real estate, can any of you remember why that might help them to be full-time in real estate if they have passive rentals or rentals that would typically be classified as passive?
Well, if they're being full-time real estate managers, etc., then if they spend, I don't remember if there's an hour limit on it anymore or not, but then that qualifies it as then it's no longer non-passive.
Right. So remember, long-term rentals are automatically considered passive activities unless you can be considered a real estate professional. Short-term rentals are a little bit different. The rules for non-passive are different, but for long-term rentals, the only real way to have a long-term rental considered non-passive is that rep status, real estate professional status. It's almost impossible. I say almost because like anything in tax, it depends, but 99.9% of the time, it's not going to be possible to be considered a real estate professional if you have a full-time W-2 position in something not real estate related. So it's important that they've left their jobs because it unlocks some areas of the tax code that would not have been available to them otherwise. So they left their jobs last year. They're going all in on real estate. And then this year, they've decided to try their hand at fix and flip. Since they're both full-time in the business, they're going to be active in the flipping process, either helping with the demo, helping with remodeling, directly managing the contractors, whatever it may be. They're going to be active in the flipping business. So they bought a historic house in downtown Richmond for $700K. They put a bunch of money down. And then, of course, they had closing costs. They had a bunch of money into renovations. And so this is the basis for the scenario. They're hoping to fix it up and sell it for enough to make a $250,000 profit. They used a hard money loan for the difference between the purchase price and the down payment that they paid. And then the question is, what will it look like if they sell it? What will it look like if they can't sell it? Talk through the different tax strategies to potentially help offset some of their gain from the sale. And so that's the foundation for today's discussion. Any questions about this scenario? Cool. I'm gonna stop sharing my screen for a sec here. All right.
And Imelda, maybe you could drop that document too into the chat, the scenario document, just because some people might pick different things out of it even as we go. Andrea doesn't have to share it the whole time. Maybe drop that file in the chat if you don't mind.
Okay, give me a second.
Yeah, take your time.
All right. So one of the things that I want to touch on real quick as we set the stage is talking about whether fix and flips belong on Schedule C or Schedule E. And this generally isn't a question. Usually the confusion comes with short-term rentals, whether they go on C or E. So we'll touch on that in just a second as a refresher. For a fix and flip business, where do you think that gets reported? Which schedule? Normally, fix and flip should be incorporated. Maybe, maybe not. Okay. So yes, Robin says Schedule C. Let's assume that they don't have an entity. It would report on Schedule C. A fix and flip business is just considered like you're selling widgets. So I buy widgets and I turn around and sell them, or I manufacture widgets and I sell widgets. That's an active business. It's a Schedule C. In the fix and flip world, in real estate investing, when you're doing fix and flips, the houses are considered inventory. They're not assets. They don't depreciate. They sit in inventory until you sell it. So it's just like a manufacturing company where all the costs to manufacture the goods sit on the balance sheet until you sell that item, and then you recognize cost of goods sold to offset the selling price. Fix and flip houses work the same. It's just as if you're building and selling a widget. So in the fix and flip world, you buy the house, you're putting all this money into it. All of those costs are accumulating on the balance sheet, not as fixed assets like in a rental property in a buy and hold business. You can record its inventory, or you can have a separate set of asset accounts called, fix and flip expenses, however you want to track it. But it's all going to accumulate on the balance sheet of the books. This is not the balance sheet on a tax return. Balance sheet on the books. And then when the house finally sells, you're going to recognize revenue for the gross amount of the sale. So in this example, if they are able to sell it for $1.25 million, which was their goal, you're going to recognize on the Schedule C gross revenue of $1.25 million. And then all of those costs, the purchase price of the house, all of the accumulated expenses, all of the rehab costs, all of the utilities they paid throughout the rehab process, all of that has been accumulating on the balance sheet. It all moves as one lump sum to cost of goods sold on the Schedule C. So I did a very basic Schedule C to show you what that would look like. Let me share my screen real quick.
And I see a comment here from Jolie. Thanks for the comment, Jolie, about normally fix and flip should be incorporated. So probably that's referring to like an LLC, right? An entity as opposed to like a C corporation, right?
Yep. We're going to talk about that in just a second.
Okay. So single member LLC would still be reporting on a Schedule C.
Schedule C.
Right. Okay.
Yep. All right. So you guys should all be seeing my sample taxpayer profit and loss, right? Okay.
Yep.
So in this example, if they sold the house for $1.25 million, we're reporting gross receipts on Schedule C of $1.25 million. And then we're subtracting out cost of goods sold. This $1.03 million is the $700,000 purchase price. It's the closing costs they paid to close on the real estate deal. It's the accrued interest for the loan that they had during the flip process, if any. It's all the costs to get that property in a sellable position. So all those costs accumulate, and all in a lump sum, they move over to the Schedule C as an expense, leaving their net income, gross income, of $220,000. So in this case, they don't have any other expenses related to running the flip business. It is possible that if this is a thing they do all the time, they have expenses related to the business itself, not to that specific property. And if they do, those are going to report down here in the normal business expenses. In this example, we don't have that because I was trying to keep it simple.
So let's say from the doing the book side, which I think would be very, interesting as a service for these kinds of clients, because it's so important that they know like which properties they make money on, which they don't, all those kinds of things. So I guess you would, under this scenario, maybe have like the purchase price for the home, the rehab costs, the closing costs, utilities or something. So you might have like 4 or 5 categories of expenses, right? And then would you like ideally set up some kind of like class tracking by property or something like that?
Yeah, so in QuickBooks Online, and I'm going to speak specifically to that software because that's the one that I use. It'll work a little bit differently in other softwares. In QuickBooks Online, classes don't work with balance sheet accounts.
Okay.
There is another option called locations. And so we would typically use locations. And so on the balance sheet, and I don't have this ready, but we can probably spin up an example, or I can create one and send it to Imelda to add to the platform for today's session, like a sample chart of accounts. On the balance sheet, you would have an asset, maybe called, fix and flips. And then to that, you would have sub accounts for, original purchase price or property purchase price, another sub account for closing costs, another sub account for rehab costs, another sub account, like whatever's meaningful to your client to track. You can have sub accounts for all of that. And then every time you code transactions, you would tag them to that house's location, because some people will have multiple flips in progress at the same time.
Yeah. And you would probably have like an interest expense as well if you're paying interest. Okay.
Yeah. So like accrued financing costs, that would be another sub account on the balance sheet. So you can get really granular with the tracking. It'll really depend on your client, and it might depend on how many flips they have going on at once. If they are just very consistently only doing one at a time, then you really don't need to have classes or locations, because all of the costs hitting those accounts are related to that one property. So it really depends on your client and how active they are in flipping.
Yeah, and they might even, correct me if I'm wrong, but they might even use like other specialized types of accounting for real estate or for cost tracking that they, have from their network or something like that. That's maybe like a different type of solution that you're then trying to interpret stuff from that system, right?
What I see happen a lot, especially with real estate investors who do their own bookkeeping, is they're accumulating all of the costs on the P&L because that's where it's easy for them to track.
Right.
So then I, as the tax person, if we get to the end of the year and the house hasn't sold, I will close out all of those expense accounts to the balance sheet rehab in progress account.
Interesting.
And then put them back the next year.
Okay.
So I see that a lot.
That makes sense.
I've done that. So one of my clients he owns a construction company. They build big storage facilities. We accumulate all costs on the P&L. And then at the end of the year, we journal it all to a construction in progress, because it's meaningful for him to be able to see expenses by the 150 different categories that he tracks. And so we don't actually accumulate everything on the balance sheet throughout the year. We want to be able to run project reports. And to do that, it all hits the P&L. So depending on whether you're doing the bookkeeping or not, you may have a say in that. But if you have a client who's doing their own books or a different bookkeeper, just be aware that either you'll have to talk them through, or you may have to be the one to help them make that adjusting entry at the end of the year to get everything off the P&L and see what's truly left. So it can be a little bit more involved.
Yeah, I'm glad you mentioned that, because one of the reasons I wanted to do this training series is I feel like these clients a lot of times are quite involved in their own financials, and really necessarily, because otherwise they know they'll go bankrupt, and they probably have a lot of friends that have tried things and gone bankrupt. So, I think the teamwork aspect and the customization of different things is part of why they become such sticky clients, where they don't want to leave, because you guys have already had all these conversations about how to kind of jerry rig it or do it where it's more meaningful to me and customize the service for me, which I think for the client increases the value, right? It increases the value of the service, increases the loyalty of the client. So I'm glad you kind of gave us a window into that. Another quick question, Andrea. So let's say you have somebody that's doing a few flips or then they do them regularly as a business, right? So they're going to have all the normal business expenses like home office, they're really operating this as a business, right?
Mhm.
But let's say they don't sell any flips that year. So it's like a zero on the income. Do you feel like I still can be able to write off my operating business expenses?
Yep.
Okay.
Yep. So expenses related to operating the business are still deductible in the year incurred. Expenses related to the specific flips carry forward until the house sells.
Gotcha. Okay.
That's a great question. So in this example with the Schedule C, we've got $220,000 of net income from the sale of the flip. That's a big deal because remember, it's Schedule C income, so it's subject to self-employment tax.
Right.
So in addition to their regular income tax, they're getting hit with a self-employment tax of $25,786. Now, if this was a client who was going to do flips regularly, not just sporadic, who have maybe a good track record, this is the business that they're going to be in, for this client as a tax strategy, I might recommend S corporation. So remember, I've said before that you almost never want to hold appreciating property in a corporation. But then remember, fix and flips are not appreciating property, they're inventory. Since this is an active business with ordinary income, it's ideal for an S corporation election, assuming this business was an LLC to begin with. It's an ideal scenario for S corporation because you'll eliminate that self-employment tax. Now, you'll still have payroll obligations, so there will be some payroll tax so that it doesn't translate to an exactly $25,000 tax savings, but this is just the sale of one house.
Yep.
Imagine if they're doing 2 or 3 or 4 of these a year, it gets to be a pretty hefty tax bill. So if their business is fix and flip and they're successful at it and they plan to continue doing it, S corporation might be a valid strategy for them because it's inventory, not appreciating assets.
So this might be something more similar to like the traditional small business path of having a single member LLC, filing on a Schedule C until you know that you have a real business, and then making an S corporation election and doing payroll and saving money. That it would kind of be similar to a regular business in a certain way of selling whatever, like you said, whatever widgets. Right. Okay.
And Sean points out in the chat, self-employment tax will be affected by the person's W-2. If they have substantial sales, there may not be a benefit to S Corp. That is correct. There may not be a benefit. So I would say for this situation, like any other situation, evaluating the S Corp election, whether it makes sense, is more than just a current year evaluation.
Yeah.
You need to be talking to the client about what they expect to do next year, the year after that, because once you elect S corporation status, it's kind of hard to undo it. And if you undo it, then you can't reelect, but there can be tax repercussions to revoking S status. So this is not a like, you did this flip, you don't know if you're going to do any more, we're going to elect S corp status to save you a bunch of self-employment tax this year. This is not that. That is not the strategy for that scenario.
Yeah, so, I think the Jolie points out, to perhaps consider a C corporation in the sense that a lot of these businesses, right, will leave money in the corporation to fund the next deal, right, or to have the next down payment of wherever it is. So if you're having a recognized profit that you don't really want to recognize because you're actually leaving that money in the company, maybe a C corporation would be worth looking at.
Potentially, but remember, there's no way to get money out of the C corporation,
right,
without it being wages or a taxable dividend. So you're going to have double taxation if they do want to take some of the profit out for personal use.
Yeah.
And the 21% rate could change. Now, tax planning is always based on what we know right now. So if it makes sense in our projections to have them at a 21% rate, then maybe that's what we would recommend. But again, we need to look at the long-term picture. If this is not something that they're going to continue doing, it might not be beneficial for them to have a 21% tax rate.
Yep.
In that scenario, remember, they don't have W-2 income anymore. So their only income comes from the rental business. They might not be in a tax bracket that makes sense to have all of the income taxed at 21%, right? So this is more than just looking at that one piece of income.
Yeah, so it's
But
really could be quite an interesting scenario in a number of ways, and maybe this is a good opportunity to for us to think about, like, because this is what I find with these type of clients, right? Is like you could be trying to do tax prep, and you're like, let's get a handle on like what's already happened, and you have like a spiel of like how to try to confine your scope of work, and then it immediately expands into, well, I was talking to my friend Jim, and he said that X, Y, and Z, and like I want to get into all these extra things that pertain to like future years and past years, and I think I have that on the document of how to constrain the scope of work, but this kind of like goes pretty quickly in that direction, I feel like.
it can. And so you have to be careful. Like if you're engaged to prepare the return, that's it. You're preparing the return. You shouldn't really be spending your time talking about a bunch of things that aren't what actually happened. Because remember, returns are reactive. So you're literally preparing a return based on what actually happened. If they want to talk about, well, we're not going to sell the flip this year, but we're going to sell it next year. But what happens if we can't sell it? What does that look like? That's a planning engagement.
Yeah.
And it might
But
be easy.
Don't they almost always want to try to talk about those kinds of things? I mean, yeah,
and it can be hard
you
to
would
say no.
separate that. You would kind of like, when things start going in that direction, you would separate that in the client's mind at that time as much as possible.
Yeah, the way that we're structured at Steadfast now, that conversation might look like, hey, that's really interesting.
Yeah.
I would love to talk through that with you. Right now, you've hired me to prepare your 2023 tax return.
Yep.
I would love to get you in one of our tax advisory packages for 2024. I realize it's already August, but it's not too late. And that will allow us to make the time to talk through what might happen. We can run through the scenarios so you can make an educated decision. So it might be like, hey, this has been our arrangement up until now, but this might be a great time for us to pivot into a more proactive relationship instead of just reactive tax prep. I would love to be running these numbers with you. Let me send you a proposal for what this might look like or something.
Yeah. Awesome. Okay. I think that's really to work with these kinds of clients, to have something like that. Super important in what I've seen.
Yeah. And Tiffany pointed out clients don't compartmentalize like that. And Steph pointed out, thanks, I get sucked into this scenario. It's a slippery slope. It really is, because at the end of the day, look, I'm not going to lie. I started this business because I wanted to work for myself and I wanted to make money. It's a nice benefit that I get to help other people, right? I didn't start this business specifically to help other people. I wanted to start a business and I know accounting, so this one made sense. That said, I do love helping people. And it surprises me still every day how little people understand about their own tax situations. And I'm not even talking about complex planning situations. I'm talking like they don't understand how their tax withholding on their paycheck correlates to their tax return.
Sure.
So I love helping people understand their returns. I love helping people run the what if scenarios. So it's hard. I want to help people, and I spend, even now, even as much as I preach this, I still give a lot away for free. I can't help myself. It's like I can't shut up. So it takes practice. It just takes practice. Once you try it a couple of times, and once you kind of get a little more comfortable with your message, once you have a couple of people who you go to, maybe clients you really like, and say, hey, I know I've only been preparing taxes for you, but I see some things going on and I think we can do better. I think I can help you make some better tax related decisions, or however you want to word it. But like, I think I can help you improve your tax situation. I think I can save you some money. Do you want to explore working with me in a different capacity? Once you have a couple of people who are like, yeah, man, that sounds great, you get a little bit of confidence and the conversations become easier. There are still going to be people who are like, no way, man. And then you just have to remember, when they tell you no to that tax advisory plan, then you got to stick to your guns. And when they come to you with questions, you just have to gently push back and say, you know, that would be the type of thing we would discuss if we change our relationship to a more proactive one rather than just reactive. I would love to help you, but we need to sign an updated agreement or something. Like, it gets hard to push back, but at some point you're going to have to practice drawing that line, or you're going to stay on that hamster wheel of giving away everything for free. You're spending a lot of time, you're spending energy, you're spending money learning all this stuff. You're valuable. Clients won't see that. You'll always have people who don't see that, who think that you're just plugging numbers into a software. those aren't my people. There are clients who maybe they just have a couple of W-2s. There's not really a lot of planning opportunity there for me. And I kind of am just plugging numbers in software because that's the only thing, right? Like I can tell them to max out their 401k and max out their HSA, but that's it. So for those clients, it is a little bit of just plugging numbers into my tax software. Those people don't need to pay me what I charge now. I can't bring enough value to make it make sense. I just had a conversation with somebody yesterday. She's so new in her business and her primary income is her spouse's W-2. He's a physician. I literally said to her on the meeting, I'll send you an email with my pricing, but I wouldn't hire me if I was you. You're not ready for me yet. You're not gonna save enough money to make the investment in working with me worth it. 2 years from now, maybe, and I'm here if you need any help or direction, but like, I don't think I can help you enough to make the numbers make sense. And she responded that she really appreciated my honesty and she agrees she's not ready yet. And that's fine, right? Like not all people are my people.
And so for these clients, for these kinds of clients, like the Schedule E, especially if they have a couple rentals or they're doing, one fix and flip and they also have this and they also have a short term, they're the fertile ground for these they're the ones that if they don't pay you to do it and they keep growing and doing these kinds of activities, they're going to pay somebody to do it and they're in the market for it and they really do need it. And you can give an ROI on the service. So yeah, I'm glad you give kind of like, some insight on that, because I think that's definitely, correct me if I'm wrong, guys, but I think that's one of the main anxiety points of working with these kinds of clients is figuring out how to navigate those additional, because it could not even just be tax related, right? Like these kinds of clients, they could say like, what do you think the profitability of this type of rental would be? Like, what do you see in your other clients, right? It's the classic like person that's kind of probably a little bit of a hustler, or they want to kind of get as much as they can. So you got to kind of like handle them in a good way. So yeah, I didn't mean to interrupt too much, but I think that I appreciate that
hard
strategy.
That's probably I think the hardest part about working with clients is avoiding scope creep. It's just hard.
But it should be that it's also such a positive though, right? Because it's like, if I look at it the right way, it's this person expressing to me, I value your expertise enough to where I want you to help me with more things. And I want to hear what you have to say about these things that I'm taking huge financial risks on. And like, I really want you as part of my situation in a more meaningful way. So it really should be a positive and should be an opportunity. We just have to handle it in a certain way to make it that way, right? And that's not on the client, that's on us.
Yeah, we just have to redirect the conversation. Like, I would love to help you talk through this. That is more forward looking. And to be able to help you, I have to have information before we're actually preparing your tax returns. I need to be able to meet with you during the current year, not just after the year is over. And that might be the gateway to like, hey, we need to change our arrangement.
Yeah. And I know we have still some bit to go on that other scenario. So I don't want to derail us too much, but I that was helpful. Thank you.
Roger just reined us back in and he said, when and how does the transition from fix and flip to rental make sense? So well done, sir. Okay. So back to our scenario. Let's say they've put all this money in, they renovated the house. They're now $1 million into it, right? Because they bought the house, they put in rehab costs, they have, borrowing expenses. And maybe they put the house on the market and they can't sell it. So it's been on the market for 3 months. They're like, I can't afford to carry it anymore. We're going to turn it into a rental. That happens. It happens a lot. Sometimes it's that they can't sell it for an amount they would have to sell it for to make having done the fix and flip make sense. I will say though, one of the factors to think about, and they probably have, because like you pointed out, Andy, real estate investors are typically pretty savvy. In our scenario, they used a hard money loan for $525,000 to make the acquisition. If they don't sell it, they now have a hard money loan at 11.5% that they have to pay off, and they don't have the proceeds from the sale to pay it off. So that's one of the risks with using hard money loans. They're only good as short-term solutions. And then if you can't pay it off, you're carrying this huge note at a huge interest rate. It's not usury, but almost. So unlike a traditional mortgage, if they had bought it with a regular mortgage, and they have, a 30-year mortgage with a 7% interest rate or whatever mortgages are doing now, I don't even know. That's going to be far preferable to a hard money loan that's due within 2 years at 11.5%. So one of the things they need to think about is how will they pay off that hard money loan? Now, it could be that once they decide to make it a rental, and this is what I see happen a lot, people will buy rentals with hard money loans to beat out other buyers, right? Because they can come to close with cash. They'll get in the house, they'll do whatever renovation, they'll get it on the market, they'll get a tenant in it, and then they refi the hard money loan. They take out a traditional mortgage and pay off the hard money loan. And then they just have a traditional mortgage on the rental property. I see that happen a lot. I have a client right now, they're up to, I think they have a partnership, they're up to the 45 houses that they've bought in the last year and a half. And that's what they do. They use hard money loans to buy it. They fix it up. Once it's on the market, they take out a mortgage with a traditional lender and pay off the hard money loan. So that happens a lot. So it might make sense to transition from fix and flip to rental if they can't sell it, or maybe during that process, they're like, wow, this house is really great. This neighborhood is up and coming. Maybe we want to hang on to this because we think the value is going to go up. Or during that process, maybe they're like, I actually want to be in the rental property owning business. So instead of flipping it, I'm going to hang on to it and rent it out. So there's a bunch of reasons why you might transfer from a fix and flip to a rental. So in that scenario, let's say they went through the renovation process and it's done and it's beautiful and they love it and they decide they want to keep it. So now it's going to be a rental property. Not a whole lot changes. All of those costs, because remember, the cost to get a rental property in service as a rental also accumulate on the balance sheet. None of the costs to get a rental property, even if you buy it originally as a rental. So I buy it, I know it's going to be a rental, I'm doing a bunch of rehab. All of those rehab costs accumulate on the balance sheet and they start depreciating once the house is placed in service as a rental. So in the beginning part, not much changes. Everything is going to accumulate on the balance sheet just like it would have otherwise. It's then once it's placed in service as a rental that things change. So unlike the flipping scenario where they sell it, all the costs that have accumulated all move to the Schedule C or to the 1120S as a cost of goods sold. That's what happens with a flip. With a rental, if they keep it as a rental, they start depreciating as of the day it's placed in service. And if it's a short-term rental, they're depreciating the house over 39 years. If it's a long-term rental, they're depreciating it over 27 and a half years. So they're not going to have a huge income to claim, right? They're not claiming $1 million because they didn't sell the house, but they also don't get to claim all of those expenses that have accumulated. It's going to get dragged out. So it's kind of a big decision.
What about like the repair? Like, could I segment out the repair elements and rather than improvements and because for people that are like I want to pay zero tax, which is a lot of real estate investors as one of their main interests in life, right, is paying zero tax. So like, I want to get as much of a deduction as I can, especially against my other income, to pay as close to zero tax as I can. So do I have some options there if it goes into where I can claim the repairs, I can do cost segregation or accelerated, right off the HVAC faster? What do you think?
Yeah. So none of the costs to rehab the property to get it in service as a rental are going to be deductible directly as an expense because it's all part of getting the property ready. Okay. Now, depending on how good their record keeping is, they could be tracking the different types of rehab costs by their asset class. So in your example, like say they replace the HVAC system, they could track that separately. That could be a separate item on the depreciation schedule. They can also do a cost segregation study. So the house itself will break down into its various components. So there are ways to accelerate some depreciation if they're going to hang on to it as a rental. But either way, and that is helpful as long as they're not limited by passive losses, right? If it generates a bunch of passive losses that they can't take, they're not really helping themselves. Well, they are because they'll have shorter asset class for some of the expenses, but they're not going to get a big, huge depreciation hit if it's limited by passive loss rules. But so they can do a cost seg. They can track their rehab costs into the different asset classes, and then that doesn't have to get split out over 39 years or 27 and a half years when the house is placed in service. So there are definitely some strategies to help reduce how long it takes to recover their cost, but they're still not going to be able to just take a big old chunk in the year that the house is placed in service.
Well, we can try to take as big of a chunk as we can.
Yep.
We can do our best.
And then those strategies can differ depending on whether they're placing it in service as a short-term rental or a long-term rental. Because remember, rental activities are passive. Short-term rentals are considered non-residential rentals. And so QIP, if they do a cost seg, they might be able to get some bonus depreciation on some of the items that are broken out on the cost seg study. Whereas long-term rentals, that will not be an option. So you can see that having this discussion with this hypothetical client could become a really involved analysis, right? If they're like, we're in the rehab process now, we're trying to decide if we want to follow through with selling it or convert it to a rental and then short-term or long-term. There's a lot of different scenarios you're going to be running, a lot of different calculations you're going to be completing to help them make that decision. So it's pretty involved.
Yeah, so you have to kind of manage that, your involvement as to what role you are, have enough expertise to do or have enough other resources like this type of group where you can show up and what you feel is profitable really for your own business. Otherwise you kind of can, get into feeling bitter that you're doing a lot more work and not getting paid more money. Can happen.
That was me. Y'all know, a lot of you have been around long enough to have heard my story. I was ready to lock the door and walk away forever because I was underpricing and over delivering. Like that's only sustainable for as long as you have the metal to muscle through. And like, I just got burned out.
So you actually made a change because you were burned out as opposed to just burning the rest of the way down all the way to the ground. Interesting. What do you think about Jolie's question here about because I know some people don't go for the accelerated depreciation methods or the cost segregation stuff. They think, well, now I'm going to have to recover back this or deal with like salvage value and like different like repercussions from that. So Jolie said you have to recapture depreciation for these 5, 7, 10-year assets if they do decide to sell the property, right?
Yeah, there's mostly, so as with everything else, it depends. There will most likely be some kind of recapture. It could be Section 1250 unrecaptured gain. It could be some depreciation recapture. It depends how much they sell the house for, how much profit. But yes, it is possible. And that's another factor. So as you're talking with your clients, and this is a conversation I have, especially related to cost seg studies and taking accelerated depreciation, how long do they plan to hold the house? Like if they already know they're going to hold it as a rental, but they're probably going to sell it in the next year or two, it might not make sense to take accelerated depreciation. I realize $1 today is worth more than $1 tomorrow, and a bigger deduction this year might be valuable. But if they expect to have more income down the road, it might not make sense to take the accelerated depreciation this year, but instead let everything depreciate normally and have less gain to deal with when they sell the property. So nothing to do with real estate is going to be a short-term discussion with your clients unless it's the fix and flip scenario. Those are expected to be short-term. Anything else is going to be a conversation that you're trying to look 1, 2, 3, 4, 5 years into the future so that you can answer questions. And so it can be kind of involved. John pointed out you could live in it as a primary residence after rehab for at least 2 years and then sell. That's true in that scenario. So they buy a house and they renovate it. Maybe they live in it during the renovation. Maybe they don't. But once it's done, they move in. If they hold it for 2 years, then they could potentially qualify for the Section 121 exclusion and exclude the gain. They won't have any depreciation deductions and they won't have any expenses that they can write off once the reno is done. So back to that hard money scenario, at that point, they may want to take out a regular mortgage so they can pay off that hard money loan, because that's going to be too expensive to hang on to for the full 2 years. But it is possible.
Yeah, I've seen a number of clients do that as a, the downside obviously is they're living in a construction zone at that point for 2 years, which anybody who's done that game is has its own costs, right? But yeah, I think that is something that clients do and can save a lot of taxes for sure. So did we have anything else on that scenario that was like that you wanted to touch on? I know we just have about 16 minutes. I'm thinking probably people have some questions and comments too. Appreciate you guys all chiming in, or a lot of you in on the chat. But anything else you wanted to touch on before we kind of go into more Q&A, Andrea?
I don't think so.
Yeah. Was this a good exercise, you guys? Is this something that with, I know with fix and flip, that I haven't done a lot of them just because I kind of didn't want to get into this whole thing. So it's, I know I learned quite a bit from this. I hope you guys did too. The idea of providing a comprehensive service to these kinds of clients, like that includes the accounting piece. I think that's partially why I was like, I don't really want to get too deep into this, because I feel like the accounting part of it and the bookkeeping part of it is such an important part, and I didn't want to offer that. So maybe you could, like, on a comprehensive service for these kinds of clients, because some of the people, I think you're dedicating your time to be here, especially on a Friday, right? And so that's saying, this is important to me, right? I'm interested in this, and I'm interested in working with these kinds of clients. So could you, like, business-wise, with you being, a business person that we respect, Andrea, could you talk about like package pricing, like that would include some kind of either doing the bookkeeping or maybe like quarterly or monthly, like consulting on the bookkeeping? Because I think the package piece of it, where it's like the person's not just getting tax prep, is really an interesting opportunity for the people that are on the meeting right now. Could you talk about that from like a business point of view, pricing wise? Can you dedicate team to it? Like, I know you have this pod model that you've got going for your, so for maybe, for example, for the 45 house client, like that's maybe on the higher end of what we would be working with, but like business wise, what does this opportunity look like?
Yeah. So there's a whole bunch of ways to skin this cat. One suggestion, if you don't want to get into the bookkeeping, is that you can create a spreadsheet that is in a format that gives you all of the information you need to do the returns, and you can require your clients to use that spreadsheet so that at least you're getting information from your clients in a consistent format. And maybe that's a thing that you develop, and then that's part of the onboarding process, right? Or part of the discovery process. Maybe you're telling them like, hey, we don't require that we do your bookkeeping, but we do require that you use our format to give us the data. We will provide you with a spreadsheet. We require it from all of our clients. So that's at the, I'm not going to say lower end, but if you don't want to get involved in the accounting, maybe that's an option. You develop the template that works best for whoever is on your team is doing the returns. Yep. And that way, all of your clients are submitting data in a consistent format. So you're not having to try to interpret whatever garbage they put together from their own spreadsheet. So I like that model. If you're going to work with real estate investors, that might be a really workable solution. A lot of them use programs like Buildium if they're a larger real estate property owner. They use Stessa. You'll start to become familiar with the different property management softwares. Yep. But they all spit out data in a different format. So you can say, sure, you can keep your books in whatever system you like, but for tax prep purposes, you need to put it in my format. So that's one end. For us, our packages have recently, and our pricing has recently changed. So I'll tell you what we did before, because our prices are higher now. So people who only have like 1 or 2 rental properties, they're not going to hire us. It's going to cost too much. So at the lower end, so we have here's a spreadsheet, you do everything and send it to us. Then we also offer a quarterly review of self-prepared books, whether that's a spreadsheet or actual software. This is now required of all of our clients who are tax-only clients if we don't do the accounting. We require a quarterly review. So that means that once a quarter, we're reviewing whatever documentation they're tracking for their business, be it a spreadsheet, be it accounting software. They're going to invite us to it. We're going to look through, ask our questions, get all those answers every quarter so that we don't get to the end of the year and have a bunch of problem children to deal with. We're catching it throughout the year. We're having conversations. So what that looks like for us is it's $750 a quarter for that accounting review. And then the tax package depends on whether they have an entity return involved or if it's a 1040 with a Schedule C or Schedule E's. But in basic terms, the tax package would be anywhere from like $150 a month to say $300 a month, somewhere in there, plus the $750 per quarter for the review. And then if we're doing the bookkeeping, the monthly pricing would depend. Obviously, our client with 45 houses, that's a much different bookkeeping package than somebody who has 1 or 2 rental properties.
Yeah, so it'd be like $750 times 4, $3,000.
Yeah.
150 times 12, 1,800, so $4,800.
Yeah.
Okay, so that would be a price point that people would self-select into that level of value, whether they felt like their situation needed that, right?
Right.
And if it wasn't right for them, maybe like somebody further down the road that they know, if they still were impressed by what's going on with your business, and you have enough profit margin there to like dedicate team to their account to actually follow up on the quarterly things when they don't respond and try to get them to utilize it. Interesting. Okay, so that would be I think pretty appealing for a lot of people on the call, right? That type of number of these, we're all kind of looking for what are those like loyal clients that stick with you that are high profit margin in a way where the client's happy to pay and they see the value. So I think that's a really good kind of, and then kind of up from there, what does the upper end of that look like business wise, do you think?
So our client that has all those properties, they have a person in-house, they have like an in-house property manager who is in QuickBooks doing a lot of the expense categorization because he knows which expense goes to which property. Okay. Remember, we've got 45 different houses that we have to track costs to. Yep. Gotcha. So we're splitting the accounting work. He does that piece and I do all of the like making sure the mortgage payments are allocated to the right properties and the interest is broken out and that costs
the CPA,
that are
kind of the CPA level. Yeah. Okay.
Costs for houses that aren't in service yet are being tracked separately. Yep. And that engagement is a $3,500 a month engagement that includes the bookkeeping and the partnership return. They've got, I think, 6 partners now. So that's a higher end engagement for us. And honestly, with the number of houses they have, that might actually still be a little bit underpriced, but he's got other entities with us. And so he gets kind of like a multi-entity discount. That's a really high end. I am the one primarily doing the accounting work. So instead of my team, because it's complex and I haven't had time to train any of my team members on it yet, it's me doing the work. And so that comes at a premium. So that's a higher end, right? And those aren't usual. He's our biggest real estate investor client. It's pretty unusual for us to work with someone who's that active in property acquisition. A more common scenario for us is somebody who's got, 3, 4, 5, maybe they're going to acquire 1 a year, slow grow. So yeah, that's a little more typical for us.
It's just interesting though, for like people, because I know a lot of people on the call have like bookkeeping skills and background, right? So it's like if you have $42,000 a year for something that a lot of us enjoy doing and we would like working with that kind of client, it sounds like it's be a really good thing. I mean, you only need like three clients to be, bringing in over 120,000. So yeah, I like the. It's nice. Like if we hear, hey, there's a lot of ways to skin the cat. There's a lot of different approaches. I feel like sometimes I don't view that as a plus because I'm like, I want you to kind of give me like a couple different ways to skin the cat that I could do. Yeah. So I think that like real life package pricing and how would you approach it business wise, like give us a thumbs up because I love hearing that stuff from Andrea and from the other mentors. But I really appreciate the like business side insights to see what the opportunity looks like, because we might already have clients that we're doing very similar services for. That's actually, I think, probably from what we've heard from members, like one of the ways that your profits most increase from the membership is like hearing what other people are charging for a very similar service and realizing, hey, wait a second, if my client went out and tried to shop for this service, they're actually going to have a new appreciation for what a bargain I really am.
And a couple of points, back to the minimum package. Part of the goal when we switch to this package pricing is we want to talk to our clients more than just once a year. We want to have conversations so we can do a projection, so we don't get to tax season and they find out they owe, or we find out about all this stuff that happened that we didn't know about.
Yep.
And by baking it into a monthly fee, they don't feel like they're being nickel and dimed, right? They're not getting a bill every time they call us or email us. It encourages them to reach out to us because they're paying us whether they call us or not. And we want them reaching out. But then we also have the time to be able to respond because we're able to work with fewer clients. So it's a win for everyone. It can take a little while to get there, but it's a win. And I did this at 2 knowledge share extravaganzas ago. I put up my actual numbers over the last 4 years through my pricing adjustments, my actual gross income, net income, or in the first 3 years, net losses. So I promise you it works. It can be hard. You're going to have hard conversations, but it definitely works. Tosin did point out, though, the fee makes sense. It's great insight, but it really hurts when those high ticket clients leave. So if you have a $42K a year client, it stings like a mother if they terminate services. So as you're thinking about what direction you want to take your business, be thinking about what level of service you want to give. That $42K a year client is probably going to expect quite a bit more from you than the $3,000 per year client. So maybe you're more comfortable having 50 of those $3,000 a year clients instead of 3 of the $42K.
Yep.
So you just have to think about like what level of service, what can you commit to? I want to under promise and over deliver. So which business model allows me to do that comfortably without overextending myself? It's fun conversations, fun things to think about.
Yeah, and if you guys, I think the talk that at the Knowledge Share Extravaganza that Andrea is referring to is probably one of the best talks that we had at the live event. So you should have access to that recording and also all the slides from that presentation where she literally provided like the actual numbers of like, hey, I took this really bold price increase strategy and like, here's how it worked out. Here's how many clients I had when I started. Here's how this was. Here's all my revenue. And it was one of the most awesome. I mean, people just loved it. So remember, you have access to that. If you can't find it, so you should be able to search Knowledge Share Extravaganza in your dashboard, and you should be able to access that. And you probably find some other stuff that might be interesting to you as well. So this is part of the whole thing of we're trying to do a better job of communicating what you actually have access to as a member. So if what Andrea said about that topic sounds interesting to you, and maybe you're even dealing with some of those things yourself, definitely jump into that recording and grab the slides. And she has like a whole case study example. So highly recommended.
Also, y'all, don't forget, and maybe you weren't part of the group then, but I want to say it was either earlier this year or last year, I did a multi-part series about short-term rentals, mid-term rentals, and long-term rentals.
Yep.
All the different strategies, how they're taxed. Those are in the platform as well. So if you want to go back and watch those, like we dug into the nitty-gritty, how short-term rentals are taxed, what are the advantages and disadvantages, how are they different from mid-term rentals or long-term rentals. So if that's something you're thinking about getting into, definitely go back and check those out. Those were fun sessions.
Yeah, and actually that's a good point. With this, we really got to do this video, Melda, of this. So we invested in a new tool across our platform that enables you to search by search term and it'll generate the results that pertain to that throughout the entire platform. So typical Pronto, we like invested in it and then we didn't tell anybody that we had it. So, but you should now be able to go into your platform, your Pronto platform, and plug in like short-term rentals or Airbnb or earn income credit, and it will should pull up the results directly where you can consult, because we have a lot of materials by now. So we've been trying to give more accessible ways to access it. So let's definitely make a note, Imelda, to put that video together, because I want people to start using that. I also want to do a real quick, if you don't mind, a real quick, but not pressuring sales pitch. I put, especially for folks that are in Southern California already, we have our live event, once per year live event coming up October 29th and 30th. We only have 100 tickets total. So we're starting to announce the speakers now. We're going to be announcing the theme, the topics. Go ahead and check out the page there. You can see also reviews, like real reviews from people that have attended the past events. This is going to be our third one. So we're going to try to make it our best one. And we would love to see as many of you guys there as we can. I feel like a lot of interest in seeing people in person these days. Like, I feel like that's something that is actually pretty awesome. So it would be great we're going to have like happy hour. We're going to have a band, we're going to have some cool stuff going on. So we would love to meet you. And one of the best things about being able to see members in person is honestly just to say thank you to all you guys in person. That's actually one of the best things that my team and I really love to do. So we would love to have you, come to the event in October. If you have any questions about the event, let us know. And we'd love to see you there. And Andrea is going to be speaking there as well.
I can't wait.
What more do you need?
I'm excited.
You're going to see that she's a real person. She's actually not a robot.
I'm not a deep fake AI.
We're working on that, though.
Unrelated but related. Don't forget, y'all, you have the business tax platform that you can submit questions through. A bunch of us, like the group of us mentors, get notifications when you submit questions through that. And then you also have the Tax Preparer Teamwork Facebook group. That's a great place to post questions, because I go in there pretty regularly and get some of my topics from there, and I will answer whatever questions you post. So feel free to @ me if you want me to chime in, but I'm in those groups pretty regularly. So that's a great way to get questions to us. And then your questions might become topics for future sessions. Yeah,
totally. And our vision on it, which Andrew has been helping with so much, is that we want the independent, smaller tax offices and tax business owners to not only have as much support as you would have in a franchise or at a big company, but actually more support and actually more better resources, better training. And so a lot of that is just giving you access to mentors like Andrea. So we hope you take advantage of as much of those resources as you can. And if you ever have questions about like, hey, I know I have this membership, but I don't know how I could use it or how I could use more of it. Our support team is, I feel like, pretty responsive. So please reach out anytime. We're a couple of minutes over already. Andrea, great session. Thank you so much. Thanks, Andrea, for hosting. And thanks, everybody, for showing up on Friday. Hope everybody got a lot out of it. And we'll see you next time.
Good to see you all. Bye, everyone.
Thank you.
Thank you for joining us. I'm Imelda. Join us next week as we continue to share mini audio clips of Schedule E tax prep process. If you are interested in listening to the full process and want to be part of our Dream Team community, please visit prontotaxschool.com or email us to support@prontotaxschool.com. Being part of the Dream Team membership comes with getting expert support, top-rated training programs, and weekly video live events. We look forward to having you on board.